Hello, my name is Iker Suizarreta, CFO at FLAR, Fondo Latinoamericano de Reservas. This session will be conducted in English. I will now be making a small announcement in Spanish. Esta sesión va a ser conducida en inglés. Tenemos traducción al español. En Zoom, por favor, seleccionen esta opción de traducción. Para asistencia, usen la herramienta chat y con gusto les atenderemos. Welcome to this 7th edition of our Cartagena Talks. In these times in which we unfortunately cannot meet in person, this is a space especially created to foster the communication and collaboration within the official institutions of our region. We're very grateful that you were able to once again accompany us. We hope that you're navigating safely and effectively these challenging times, both in your personal lives as well as in your organizations. This session is being recorded. It will be available for replay. Please ask your questions in the chat tool in Zoom, and Eric will be asking them to Monica. Please do so as early as you can in order to have better chances that your question will be asked to our speaker. Please include your name and your institution. For those of you that have been with us, accompanying us since April, you may recall that in our first 5 encounters, we reviewed regional and global trends, and in our 6th meeting, we covered the very timely issue of US elections. In this occasion, our 7th encounter, and in the midst of a year that refuses to end, we are going to stop to reflect on the lessons learned with only 2 months left in 2020. In that spirit, I know that Monica will help us to gain a broad perspective and make sense of what is a very fluid situation. These 7 encounters since April constitute the prelude to our 34th Conference of Central Banks and Official Institutions that will take place in November. Please stay tuned. At the end of the session, we will provide you more details. Our host today for this 7th edition of our Cartagena Talks is Erik Guzmán. Erik is a long-standing member of our research management community. He's responsible for the area in charge of the investment of the Bolivian FX reserves and other international operations. We are very delighted and grateful to Erik and to the Central Bank of Bolivia for their support to this initiative that aims to keep us connected and to foster an open collaboration in our region, Latin America. I am very much looking forward to this session. Without any further ado, I leave you with Erik. Erik, muchas gracias por acompañarnos hoy. The room is all yours.
Well, good morning, Iker. Thank you very much for the invitation to host this session and to FLAR's team for organizing this season of conversations with world-class experts from all around the world. It's really a pleasure. During the past 6 conversations, the discussions were around the pandemic dynamics and the interaction of the different financial markets and economies by region. The topic for this conversation is an extremely relevant and interesting one, the day after what we have learned from the COVID-19 crisis, where Monica will share with us the lessons that this crisis has left us so far and try to summarize the main takeaways that for sure will be quite useful for all of us international research and unofficial institutions managers. Monica Defend is the global head of research at Amundi. She is a member of the Global Investment Committee and Advisory Board, where she contributes to the definition of Amundi's investment strategy on financial markets. She holds master's degrees in economics and financial economics from the London Business School and Bocconi University, and an MBA degree from the London Business School. I would like to mention that Monica leads a team that relies on a strong quantitative approach that analyzes the different trends and fluctuations of financial markets in order to define short, medium, and long-term forecast and investment strategies. Monica is joining us from Italy. So good afternoon, Monica, and the stage is all yours.
Thank you. It's a pleasure and an honor to be here today. We are still, unfortunately, learning from this COVID-19 pandemic that seems not to be over. And we are entering new restrictions in Italy. Yesterday in France, a new lockdown has been announced. So still, we needed to adjust with what we have learned a few months ago, and then protect our lives and portfolios going forward. Today, I prepared a set of slides because, as you were mentioning, I'm leading the research department, And as such, we are looking at top-down investment recommendations with a model-driven attitude. And one of the questions a few months ago, our CIO Pascal Blanquet asked me was, look, I'd like to know how the portfolios are exposed to macro risk factors. And the reason was simple. Markets continue to be driven and highly sensitive to macro risk factors. Since the global financial crisis, we are used, for example, to see big intervention from the central banks that actually have been preserving the financial stability, but on the other side, they've been changing some of the relationship in between the financial markets. And we moved along on that way, and we deployed something that I'm going to present you, that is our approach and systematization of the sensitivities of the various asset classes. We cover 250 asset classes to some selected macro risk factors that, according to us, are the key drivers of the financial market, and on which we do have our own forecast, so that if you know sensitivity, if you know or you expect some direction into these macro risk factors, you know how to better adjust your portfolio. So if I'm allowed, I will start with the presentation. Can you see it? No. Share screen.
Not yet. I think there it is. Yes, there it is.
Yes, just a second. Because as my son always tell me, Mom, you are Paleolithic, digitally speaking. Okay, can you see that?
Yes, it's perfect.
Okay, so what are the main lessons that we learn from the crisis? That as any crisis for us was a moment to rethink what we were doing and how we were doing, and to evolve and finding new solutions. So the situation was terrible, but on our side, on the research side, it was quite challenging and really fascinating to a certain extent. First, we realized that the macro financial environment was evolving extremely fast, and we were lacking of data. For example, because of the lockdowns, even CPI numbers were not available, or they were poorly representative of the reality. Then there has been this shock that has been affecting all the economies, and that has been spreading on the full spectrum of asset classes. But the way this has been affecting was uneven, different in time, different in size, and the governments and central banks at the very beginning choose a different way to tackle with the pandemic. Then we realized that there was a big decoupling and disconnection between the macro fundamentals, starting from the GDP numbers, but also initially the earning per share, for example, the confidence indicators, and the markets. In particular, on the risky asset, we have seen equity markets continue to move up, in particular in the to lift higher, in particular in the US. But also on the credit side, spreads are really very compressed, given the macroeconomic situation. And the reason for that is because we do have central banks on one side that as a primary target wanted to preserve the stability of the financial market, and the governments that had to first tackle with the pandemic, so had health, preserving health and wealth of their citizens, and now they are organizing how to move forward. So eventually, we've seen really a larger role of these authorities in the market functioning. A lot of enterprises, for example, in Europe, has seen a participation of the state, which was, if you want, something really revolutionary compared to the past. On the fast evolving macro financial environment, what we had to do was to track really high frequency indicators such as mobility and transportation usage, electricity usage, and we have done this. I reported here the US and Europe, but obviously we have been tracking those indicators worldwide, starting from China, Asia, but also LATAM, where we struggle a little bit to find the data. And in order to approach this big mass of data, we need also to evolve on the technique we were storing this data. We are now using Python to code and to make our database and analysis faster. And we had to use artificial intelligence as well in order to improve our capacity to look at big sample of data. This is what happened on the markets. We've seen at one moment in March, everything was collapsing, and then back in May, when the Federal Reserve announced that fallen angel would have been included in their purchasing program, everything was moving up. Even the safe haven in March were not working. So to this extent, we do believe that the central bank support for the markets and the pandemic related news were the two main drivers of the financial market. And correlations actually were kind of unusual, because safe haven were not playing out as safe haven. Or if you look, for example, at the US dollar, back in July, August, September, its performance, its weakness was much faster than what we were expecting. And again, the backstop of the central banks created some confidence on the investors that there will be someone always backing them up. This is the disconnection I was mentioning. This is how on the left-hand side on the chart you see GDP numbers in terms of year-on-year changes, and you see how deep has been the collapse and how smoothed in time is the recovery, the revival. We saw a very good third quarter, which was a technical rebound, but from then we expect a smoother growth. Obviously, with these new restrictions and a new set of lockdowns entering the equation, we are going to revise, unfortunately, to the downside our expectation. But this heterogeneity in the convergence is something that, from an investor perspective, is opening up some investment opportunities. Market performances, if you see, this is something honestly unbelievable from someone like me that has this economist hat on his head, because the way investors, the markets have been behaving has been rather astonishing. And in fact, if you look at the flows of the institutional cross-border investors, so the big institutionals, they've been much more light in terms of risk positioning, because they were believing that when the disconnection between macro and fundamentals gets so wide, this gap might be very, very dangerous. When I say the larger role of the central authorities, we are quite used to have quite proactive central banks. In this pandemic, the reaction function has been even more faster than it has been in the past. If you look at the ECB, for example, Governor Draghi needed 4 years in order to implement the whatever it takes. Madame Lagarde in 4 months just reestablished this whatever it takes 2.0. But this is by far the most significant driver of the market. If you look at the, this is actually something we measure, the expansion of the central bank balance sheet, the Fed, and the S&P 500, there is almost a one-to-one relationship. And this is something that it is going to stay. Governments were quite fast as well. If I look at Europe, for example, where we have been for a long time having this discussion about the fiscal union, how to share the debt burden. Well, the political decision was quite fast, because we agreed on the recovery fund back in July. Now we will see the execution gap might take longer, but the political commitment has been quite high. The other flip of the coin is the one that it is difficult for us today to make a proper assessment on the corporate sector, for example, of their solvency profile. Because of the liquidity and the credit lines opened by the central banks, and because of the state guarantees and state aid that has been implemented, the defaults so far remains quite contained. This is something that we do expect to move higher in 2021, or as soon as, at least on the government side, we will see those kind of guarantees fading out. How we've been changing the research approach, starting from the economics. First, as I was anticipating, we had to take into account not only GDP and its component and the economic trends, which is something, the traditional approach we do have to macroeconomic forecast. We use Bayesian vector autoregressive models in order to increase the number of variables that we can take into account. There is the confirmation that growth, inflation, nominal rates, monetary aggregates, debt, both on the public and the private sector, and liquidity remain the key macro factors to look at. But it is important to map not only the base scenario, your main story, but also the alternative scenario. What if? On the upside and on the downside. On the financial market, having in mind this base and alternative scenario, we tend to map financial regimes according to these variables, so that we cluster financial markets into the different dynamics of these variables, and these allow us to define 5 financial regimes, according to which asset class tends to have a peculiar dynamic. And then usually what as asset manager we were used to do was to define the strategic asset allocation, to have the tactical asset allocation, and starting deciding how much equity, how much duration, how much credit versus govies you want to hold. Now we think that we really need to switch the diversification. We moved, actually, we continue to have both a benchmark and an absolute approach, but this sensitivity according to the macro risk factors, state dependent and regime based, it is something that make us feeling more comfortable in an outlook that remain highly uncertain and unfortunately highly unstable. So we deploy GREAT. The alpha version of it was coded into Python, and the analysis has been done on Excel. And now, because we want this to be implemented into the real portfolio, we are switching it, the coding into our risk budgeting framework. We have been expanding the global macro risk factors, taking into account, because usually we had the growth and inflation as the key driver. We broaden it to the central banks and monetary aggregates and the debt volumes, because this is something that it is very important today when we talk about the central banks, while the debt volumes is something that sooner or later we will have to address. On the macro risk factors, we do believe that it is important to fix some macro risk factors and to test the sensitivity of these asset classes to the factors. Let's make an example, because this is different. So you don't have to take equity as a whole, but you need to consider Japanese equity and US equity, for example, because if you look at the sensitivity of this equity index to the balance sheet expansion of the central banks is definitely different, just because Japan has been in a balance sheet recession for such a long time, while vice versa, the US proved to be quite sensitive to the expansion of the Federal Reserve balance sheet. There is a nonlinearity, meaning that depending of the level of the macro risk factor, low growth, medium growth, high growth, the sensitivity of the asset classes might change. And this is, again, something very relevant, because on the market, there are some applications such as Barra, for those of you who might be more in the on the investment side. But the non-linearity, it is something that those kind of applications don't take into account. And for us, this is something relevant, because one thing is, if you are talking about inflation that is between 0 and 1, 1 and 2, 2 and 3, 3 and above. So provided how sensitive central banks are with their inflation target, this is really something that you have to take into consideration. And last, provided that the macro risk factors that we identified are the one where we do have forecast, it is when we build a portfolio, we check the sensitivity of the portfolio to the risk factors, but we add on this forward-looking dimension, meaning that if we are expecting to progressively move to a higher growth profile, then some rotation might be needed. Like it is the case. It will be the case between, for example, high yield credit and equity in the future. This is something that we are planning to do on the portfolio. Those are the variables that are taken into account, how we proxy growth into GREAT, inflation, nominal rates, the aggregates, and the financial condition and liquidity and risk sentiment. The last line is something that has been quite powerful in giving the explanation of the markets movement. This is how we see what I was saying. You need to take into account the different equity index. You have the US world growth, and Europe, and the sensitivity, how this is varying according to the regime you are having in the macro risk factor. So for every risk factor, we identify a low, a medium, and a high level as a reference, and we check the sensitivities for each of these cluster, for each of the asset classes we were taking into account. At this stage, the artificial intelligence, because we were working on the concept of distance, having this artificial intelligence kernel distribution was something helpful in order to work with the big data on one side and non-linearity of the relation on the other. So you end up with this, which is basically on one side you have the macro risk factors in the first column that we do believe are important, and how we expect them to evolve over time. So the dot is where we are now, and the arrow ends in where we do believe we will end up on a 12-month horizon. This is the blue line. While on the green and on the red, you have the upside and downside regime. As I said, to us, 2008, the big lesson we learned back at that time was that when you build a portfolio, you don't have to position 100% on your base scenario. It is important to blend and to hedge your allocation, having in mind the downside and the upside risks, so that you can evaluate whether you want to be active on one position, and the cost of hedging this position is more than covered by the benefit of having this position in place. So in a 12-month horizon now, let's see, Q4 will be again revised to the downside, but we do expect that the policy efforts will move growth from a low regime to a medium regime. Inflation will remain low, but will increase below the targets of the central banks, in particular in the developed markets. So we have a 1.75 for the US, 1.5 for Europe. In the emerging market, we might see some inflation to materialize sooner. Rates are going to stay low, because we need the central banks to maintain low rates in order for the governments to issue more debt and to lighten the weight of the debt burden. While we think that financial conditions are going to stay loose, and we're going to expect more unconventional monetary policy, fiscal and monetary expansion. So regime-based approach, you need to know what is your base case and what are your alternative scenarios. Big data, artificial intelligence for us is the new language, and that we needed to take into account, because big data is something dramatically helpful at a time where you have a scarce visibility on the hard data. Factor-based asset allocation, so giving the tilt to your portfolios according to your belief in terms of what you do believe are the key macro factors that are going to be relevant, and having in mind that all these factors are really highly interconnected, and if there is a mismatch in one, this is going to have a spillover effect to the other. So the COVID-19 actually is this common unknown that is building eventually some common factors that will be driving the market with some peculiarities, because growth for sure will be the key factor, and it will differ from the emerging market and the developed market, and moreover within the regions. So this is in a nutshell, very briefly what we are done. Now we are in the implementation phase, because we want our risk managers to be in the position to track the tilt to these risk factors, because we do believe that in an environment, rates are going to be low, returns in the medium to long term are going to remain compressed. You search for yield, but you need also to get very protected on your portfolios.
Okay. Well, thank you very much, Monica, for your presentation. Very comprehensive and interesting one. And as you mentioned, there has been so many changes, unexpected ones on all the financial markets, or what we were used to. Well, with the crisis of 2008, we already had to manage with a lot of and deal with a lot of things. And now with this different crisis, with different measures that has been taken to take care of it, like this coordination between central banks, the governments, the I don't know, measures, the central banks have been taking measures that we wouldn't thought possible a few months before this crisis, right? So trying to model this, to use new tools in order to understand how the markets are behaving, how the assets are moving among them, correlations, volatilities, and stuff like that. I think it has become quite challenging. And as you mentioned, Amundi has been working a lot on this. I'm quite interested in your global risk exposure attribution tool that you mentioned, and how you are working with it, changing from this asset allocation to a risk allocation, macro risk factor allocation. So can you tell us a bit more about this great tool? Which are its key features? You already mentioned some. How does it work in practice? How does it weight the different factors that are inside the model? And at the end, which are the results that you have gathered recently in the current financial markets environment?
Yeah, so as I was mentioning, in order to understand what will be the factor load that is going to prevail, it is really important to understand the financial regime you are living in and what is the prospect, because this again, is one way to customize the environment you are working with, provided that we do expect to move. Actually, we are in a recovery, because after the technical rebound that we've seen in the third quarter, the activity is recovering smoothly, but has been recovering. So growth, for sure, is the name of the game, and monetary aggregates. So those are the two key variables that for us will be key in defining, and to which we are going to give more emphasis in the next quarters. Then when the situation will be more certain, but now we're talking about 2022, when we really believe that the fiscal efforts will be implemented and will start to give some results, it will be the time to rethink to debt and inflation. So all the factors do not have the same weight. It really depends on the financial regime you do believe it is going to prevail. So this is very broadly how we emphasize the factor loads. Then great work. What we did was to take into consideration the empirical distribution of the asset classes, and for example, we found out some asymmetricity in the empirical distribution, because there are from normal, as you were seeing from the belts we were showing before, in particular on some more less traditional or asset classes, for example. So we've taken the empirical distribution. We sliced the macro risk factor according to the 3 regime we thought were appropriate, and then we measured using artificial intelligence with this distance applied some kernel filtering in order to detect the sensitivity of each asset classes. And eventually we map the asset classes to define how Japanese equities or European corporate bond, or even the currencies. What we did, for example, was on the LATAM FX to check the behavior of the LATAM FX according to the risk scenarios we have in mind. And we thought, and then you will tell me if we are right, that the Mexican peso might prove to be more resilient than the Brazilian or the Chilean. So it seems to be quite a good asset class to have in mind in the portfolio. The same for gold, because usually you think that if the economy is overheating, rates are going to move higher. Gold should underperform. But because we are able to track the sensitivity in 3 different regimes of growth, you might capture the non-linearity of gold, which is something that, for example, we have in our portfolio for an all season, meaning all these scenarios, the base and the alternatives that we have in mind. So to this extent, I do believe that initially the idea of GREAT was quite simple. The implementation was really challenging because you can imagine how to run empirical and detect distances on 3 different regimes for 250 asset classes was not a trivial exercise. So implementation was challenging, but eventually the results are quite useful for us to understand where we want to be more exposed to what. And one of the conclusions that we had was that given that we are moving into a recovery phase where rates are going to stay low, monetary and fiscal policy will be bold, it might be time to switch, to rotate out of high yield into equity. This is one of the investment conclusion we got.
Oh, thank you very much. And I think it's a very useful tool, and going with this perspective from macro risk factors and not from an asset perspective in order to allocate resources. I think it helps you to look maybe in asset classes or markets that you haven't been paying attention before. As you mentioned, the Mexican peso, gold has always been there, but I think it helps us to have a different point of view and find value in sectors or assets that we haven't been considering before. Well, and moving maybe a bit more specific to the audience interest, since we are mostly reserve managers and official institutions. As you mentioned regarding interest rates in the whole world, they are just so close to zero or negative rates all around the world. We invest mostly or totally in fixed income markets. So I would say it's a general concern for us. How are we going to get positive returns in the near and medium term perspective? So I don't know which are your comments on this. Where do you think we should look for value regarding this maybe narrow universe of investment assets as reserve managers we have?
Well, this is the big question for a lot of people, not a lot of investors, because already with the global financial crisis, things have been changing in terms of level of rates, what is the risk-free And this appetite for yield, unfortunately, has been in place, and if you want, to a certain extent, has been biasing the risk allocation of the long-term investors. So, and with COVID-19, the situation has been just exacerbating further. So this search for yield will stay there. On the U.S. Treasury, we don't believe there is much space to move higher. There will be a contained steepening of the curve, but eventually you need rates to remain low because of the equity risk premium on one side and because of the debt burden. So this is something that will remain. We are identifying some income pocket in the portfolios, and in the income pocket we do have emerging bond selectively, and usually most of it it's out of LATAM bonds. We are looking closely also to China, to be completely honest. On the FX, this is a dangerous game, meaning that it is true that the volatility on the FX front has been quite compressed. This is something that honestly I was quite surprised of, but we are starting to look again at the emerging effects to be in the income pocket. And last but not least, we are looking also to peripherals, because if you look at the BTP or at the bonus, they are offering a good yield. So there is this selection across these seeking yield appetite at a moment where govies are really for us to be included as a liquidity buffer in case of risk of events materializing, and credit, provided that both the Fed, that is some steps forward on the subject, and the ECB have been introducing credit into the purchasing program. So they are the new risk-free. So we are long on investment grade EU, just because they are under the umbrella of the central banks.
Okay, thank you very much. Yeah, it's definitely going to be a hard task for us to look for positive and returns in the reserve management sector. Okay, very quick question, my last one before we move on to the audience questions. And you mentioned that you've been using more tools. I mean, the need of machine learning, big data, artificial intelligence, I think it has become even more important now in order to capture all the behavior of the markets. And this also requires like more I don't know, more trained human resources, more technology, and sometimes that's also difficult for central banks, for instance. But what role do you think, in just a couple of minutes, what role do you think that these tools are going to play in the future of investment research and analysis, for instance?
I think they really will play a prominent role. Data, for people in the research, we live on data, and at a time where you have a scarce visibility, just because, as I was mentioning, you are not able to track the CPI index, you need to find an alternative. So this is something that the industry is going to use in a very broad sense. Also, if on the equity side, this is not your case, but if you have to work on discount cash flow models, again, moving everything to Python is much more light, and you can manage many observations. We are coding with R. So what you need, in fact, is a young and fresh brain, because I mean, I'm 48, but the new people who have been joining have really a different attitude in managing these new and in their attitude to code and to look at things. So we didn't change our machine, but we recruit more young talents.
Okay, thank you very much. Yeah, and I think, as you just mentioned, it's very important to be attractive for a young talent, but also we should find a balance with experienced people that are a bit older, like
That's
us.
why
So
they keep me on the on the job.
okay, thank you very much. Well, I have this question, which is quite related to the previous one. It's already from the audience. It's from Martin Escobar from the Central Bank of Bolivia, and is asking, the recent crisis boosted the implementation of AI in different industries. In that sense, in which tasks in regards to asset management, Amundi found that AI applications have more potential to disrupt the industry and process of analysis?
Well, we are applying at Amundi. We do have the quant department, so they are really quant. So what they are doing is basically to engineer the investment process, broadly speaking. So for the equity, for the fixed income, for the cross asset guys, and they are using artificial intelligence algorithm also at bottom up level. So on the stock picking. On the other way, we arrive maybe later than them, but just because we are not fully dedicated to quant analysis, the COVID-19 was the opportunity to be broader in the top-down implementation of artificial intelligence. But when anytime we had to manage big data, we have always been using artificial intelligence. So this process started 4 years ago. Now, and it was applied primarily on the equity indexes, on the valuation metrics, so where you really have many data. Now it's more broad, and it starts from the macro side down to the asset classes.
Okay, thank you very much. There is another question, and it says, year 2021 does not look very different than 2020, although hopefully mass vaccinations will begin. Year 2022 would probably be the year when the global contagion curve would begin to decelerate. What are your views or best estimates as to how long will it be until we can say that the pandemic is receding on a global basis? And with that, what is the limit for the expansion of central banks' balance sheet and government support? And what would be the appropriate investment strategy for 2021?
Well, so for sure, the finding of the vaccine and its broad dissemination, because it will be a matter of, it won't be just the vaccine, it will be a matter of quality and quantity. This will be the game changer. And in our view, this might be available extensively in the second half of 2021. So our idea is that from here to there, we will have a sequencing of economic relapses, but you will have central banks and governments that will kick in order to support the economy and the financial market. I'm not really sure that 2021 will be as 2020 on the pandemic front, because now we know what we are dealing with better than what was the case in March, that came in as a black swan, completely unknown. Now there are some progresses on the medical treatment. Still, there is a lot of difference between here and there. If you look at China, Korea, it seems there that the pandemic is over. And the reason being the massive testing and the sometimes coercive confinement, if not tracing, that proved to be the successful element. We think that the central banks will remain active, with more to be done, at least in the developed market, where inflation doesn't seem to be an issue. It's a different thing on the emerging market. There are some vulnerabilities and fragilities and inflation pattern that at one stage might be a constraint for the central banks. I think about Indonesia, for example. And as investment strategies, as I was anticipating, from the time being, we think that we're going to remain prudent in the allocation. We likely move from high yield into equity, and in the equity we're going to seek opportunities on emerging markets because of the first in first out theme, or where we do detect value. So some sectors in the European market, for example, where the valuation gap is more attractive. Definitely, we're going to hold the gold linkers, just because we don't believe that inflation will be an issue for 2021, but it is a nice to have. So emerging market asset classes on the full spectrum will be for sure an important asset class we will be playing out in the portfolios, followed by some peak on the European equity front. We guess on the credit side investment grade, and then we see on the currency from time to time what will be more suitable. Being active and selective is what we think might be more appropriate for the year to come.
Yeah, I totally agree. And well, just looking into the near future, we have some very important events: U.S. presidential elections, Brexit, maybe second waves of the contagions all around the world. So it makes sense to be more defensive, I would say, and not get caught on a difficult position during these next few months. Well, I have another question here from the audience, and it's related to the analytical ones. It says, have you started to use non-traditional macroeconomic data, high-frequency data, text and analytics, etc., on your quant analysis for asset allocation? And do you find it useful?
Extremely useful. We don't know the Q3 numbers, for example. So hard data in terms of frequency are released in too prolonged time. So really high frequency indicator was at that time really the real way for a material way for us to assess if the economies were recovering or not. So this is something that honestly we brutally entered during the pandemic. Before, they were not so important, and this is why we needed to use artificial intelligence in order to manage better the databases. But definitely, this is something, when you have scarce visibility, you need to look into micro data in order to have a proper vision. In the past, we had the GDP numbers. Then we thought that the earning per share, so the earnings produced by the companies, were a better tracker of real economy, provided that they are priced by the market, they are available for every reporting season. But the world has changed. So in the day after this, and as long as this pandemic continues, you will really need to look at high frequency indicators. I cannot hear you anymore.
With
Okay.
some problems, maybe I switch to another one. I hope you can still hear me. But one last question, maybe a personal one, since you live in Italy, and this has been one of the countries that has struggled a lot at the beginning of the pandemic. Which lessons do you think that has been learned from the side of governments and markets, and how can we learn from that in order to avoid more drastic or more negative effects in the near future?
You know, we are talking at a time where unfortunately the stress is getting higher and higher. I'm living in Milan. So again, unfortunately, this town seems to be a red zone. So we have really a high level of infection. Well, the first thing is that smart working is not too bad. It's something that we can do. And this will eventually prove to be environmentally better. I was skeptical, honestly, about the efficiency of smart working. But at the end, we realized that if you are an hard worker, you are an hard worker if you stay in the office or if you stay at home. So smart working is something that entered in our mind with more emphasis. There is this as such, there is this consciousness that we need to move from a digital economy into a digital economy, and hopefully into a green economy. So all the government plans in terms of implementation of the recovery fund money are going to be addressed into this kind of investments, which eventually might turn this crisis into an opportunity. We learn that for years we have not been investing in schools, educations, and healthcare, and this proves to be a mistake. So likely enough, we are seeing some money entering these sectors, and you know, in Italy we have quite a turbulent political life with a lot of turnover in the governments, very vocal. But eventually, there has been more cohesion at European level. So we all learn that together it might be better than running alone.
Okay, thank you very much, Monica. Well, I got to say that this has been a really interesting conversation. I'm sure that what you've shared with us will be very useful for all of us. I think it's quite clear now that more than ever that we must seek for out-of-the-box solutions, right, for our investment strategies, and we really need to intensify the use of the implementation of analytical tools, as you were mentioning, machine learning, AI, big data, and so. But well, besides that, I think that we should always keep in mind that that saying that says that in chaos we can always find opportunities. So, though most of the time this is not an easy task. Anyhow, what will happen next for sure will keep us all busy in the near future. So good luck to all of us. Well, once again, thanks a lot, Monica. It's been a real pleasure. And Iker, looking forward for the conference in November.
Thank you. If I can add one last, it is true that this model-driven approach are quite helpful. To have a discipline is always helpful, but brains, people, have to be in control of all these new things. So when you were mentioning it is important to have senior people overseeing it, because the experience is really important. Otherwise, you get completely involved by these big data and a lot of new techniques, but we proved on our skin that human being comes first.
Exactly. Always find the balance. Okay. Thank you very much, Monica. Iker.
Okay. Take care. Thank you. It was a pleasure and an honor, as I said. Bye-bye.
Thank you.
Wow, what a fantastic session. Indeed, we are facing very complex and challenging times ahead of us. Many thanks for your reflections on the road traveled so far and what may lay ahead. Once again, on behalf of FLAR and me personally, I would like to extend our deepest gratitude to our guest today, Monica Defend from Amundi, and to our host today, Erik Guzmán from the Central Bank of Bolivia. Many, many thanks for your insights and wisdom today. I am very certain that they will greatly contribute to add value to the investment of our public resources of our institutions. Also, I would like to very specially thank all of you, our audience today, for accompanying us once again. About our 34th Conference of Central Banks and Official Institutions, we are preparing a very special event in the coming weeks. At the end of my comments, please stay tuned for a couple more minutes, and we will give you more information on how to get your virtual pass to our November conference. We hope to see you once again. Until then, so long, stay safe. Hasta la vista, amigos.